start and preface with the disclosure that we always share that we are, you should and talk to your own advisors, financial advisors, CPAs, attorneys, etc. We are not that for you. Our job as a custodian is we are a passive custodian. Our job is to take your feedback as a self-directed IRA custodian into in your requests. And as long as the requests are filled out correctly and they're not prohibited transactions, we do what you say. That's our job. And then our job after that and throughout the years, in every single year, is we report to the IRS any contributions and distributions. So at Horizon Trust Company, we are a custodian, we are a third party. We don't make those decisions for you. Do a quick introduction today with someone who I respect greatly, and we're a boutique firm, so I'll say some things as well that might be out of the norm for corporations. But I love this guy. He is somebody who cares deeply about our staff, our community, and our clients, and the safety thereof. And I think that's really important. Steve's one of those guys who's the president and CFO of the company of Horizon Trust. And so he's involved in a lot of different transactional things that are happening. And so he's also done a lot of, I'm going to let you give a little of your background, but he's also helped over the years, even before us, doing a lot of tax preparation and planning and stuff. So instead of me going too deep on that, Steve, I want to introduce Steve Little. And Steve, you want to give a little background on yourself here before we get started?
Appreciate it, Greg. And like always, Horizon Trust is just a great place to be, great place to work for. We got great staff and obviously great ownership. And Greg, it's always fun working with you. I came across a box the other day. I've been doing taxes 38 years on my own, ever since I graduated college. And I ran across some of those early tax returns that I did, and they were hand done from form to form, like, transfer this amount to Schedule C, line 7. And sure enough, my little handwriting. And then I ran across some of my corporate returns that I did very early on, like 1988, 1989, where I tried to put them in the typewriter to make them look good because you got to send them to the banks. And, financing at that time was always sending tax returns. And so it's been a lot of years. And at one point, I had a mobile tax service business and I actually had like a van. And so in this van, I had a computer set up and I'd flip on the generator and I'd pull up to somebody's house or I'd pull up to somebody's business and run in and get their paperwork. And I'd go out to the van and start typing away on these like huge computers, back then. And soon there'd be a knock at the door and there'd be some little kid there wondering if I'm selling ice cream. It was that kind of a van. So we've come a long way. Obviously now a lot of software programs help people prepare their taxes if they know what questions are being asked and what direction they're going. And so I think they're helpful and useful, but I also think that everyone needs advisors. And they need different advisors at different phases of their lives. You have the growing earned income years where I think you need a certain type of advisor that's strong in that area to help you minimize your taxes. But as you get older and you get into RMD deductions and income and things like that, I think you need a second advisor. Not necessarily you have to replace your advisor, but replace with another tax advisor that specializes in RMDs and how to minimize taxes when, you're kind of my age, when you're older. So those are some areas. So it's a little background. I've been doing taxes a long time. A lot of corporate taxes, and a lot of individual taxes go along with that. And it's always been a challenge, but certainly an area where you can actually do some good.
Well, and I think well, that's a story I didn't know. That's interesting. And there's not, and my son doesn't even know what a typewriter is. I do. I actually had typewriter class in high school, which is crazy to think. But doing tax returns out in front of the van, in front of the house, that's new for me. That's good. I like that.
It was an innovative business at the time. And then I got phased out because desktop computers were affordable. I mean, this was before you can buy a desktop computer. And so, the computers were a couple $1,000s and not every office had one. And then slowly over a couple of years, everyone started getting office computers and I would just go into the office and do it. So it was interesting business for a while.
I love it. Well, look, we've got specifically today. Steve and I kind of talked a little bit, and he's got four topics that we're going to talk about today in today's webinar. And as we jump into those topics, the point of these webinars in general, obviously, is to inform and educate. And you can take that back and utilize it however you may wish. The other part of this is also for those individuals who have a self-directed IRA or who don't yet, who onboard, start working with us at Horizon Trust Company, using their retirement accounts to grow and build and either defer or avoid paying taxes altogether. And so, one of the biggest pitfalls in creating wealth, and issues, frankly, is taxes. It's something that, death and taxes, everyone talks about, you can't avoid. So today we're going to talk a bit about taxes, and I'll tell you this as we kind of get into the first subject that we'll ask here Steve with is we've got, sometimes it's not like people talk about working smarter and not harder. I think this is one of those subjects that is exactly that, where Steve and I both could be investing in the same kind of things, but he's using some different opportunities with using the tax code that I'm not, and sheltering it differently or investing it differently. And he could literally have 50 to 75% more money in his account just by using today's tax code. So obviously we want to hear all the hacks, Steve. So you give us the secrets. But that being said, let's just jump into some of these subjects. And so Steve, do you want to start kind of with some in each one of these subjects, some areas that might be new or might be helpful to those listening today?
Okay, appreciate that. I want to talk in four areas today regarding taxes. One of those are tax deductions. The second one would be tax credits. The third one would be tax deferrals. And the fourth one, what I would call tax avoidance. And a lot of people think that in the first category of tax deduction, that they're actually avoiding taxes. And tax deductions are really those simple things. If you're not a business owner, really deductions are a thing of the past almost these days because the standard deduction is so high. But deductions include things like property taxes or car registrations, state sales taxes, mortgage interest, charitable contributions. Those are the things that are typically deductible, that reduce your taxable income, that most people will spend on. But like I say, the standard deduction today is so high that a lot of people don't get to take advantage of it. They give me their mortgage statement and I say, well, I don't need it. You mean I don't get any tax break for this mortgage deduction? I would no, because the standard deduction is so high. And so for an individual taxpayer, the deduction is really not available to them. It's very hard to get get a deduction from your taxes. And by deduction, I just mean you're reducing your taxable income, and what you're saving is your tax rate. So let's assume in your 20% tax rate, you have $1,000 deduction of some kind. You're only saving $200 in taxes. But the mindset of most people is that I'm avoiding taxes at $1,000, and it's not true. It's only the tax savings that you're getting. For business owners, obviously that's a little different. You're trying to maximize anything that's business related, whether it's your cell phone, computer, internet, travel, equipment that you buy. Everyone always says, well, it's tax deductible, right, Dad? Oh, sorry. My kids tell me that all the time when they spend money. It's tax deductible, Dad. And I said, well, it's only at your tax rate, and you're in a 15% tax rate, Madison. So you're only going to save $150 on that $1,000 purchase. You're still going to be out of pocket the balance. And so really looking for tax deductions, certainly take advantage of them if you can, but it's not the way to go in building wealth or tax planning. It's just something that's there and available to you. And if you can do it, but it's not the best source of your tax planning. But certainly
So,
have an
so
advisor to make sure that you're deducting the right things.
So just real quick, and I know we don't want to spend a lot of time on this subject, but on tax deductions, you said something that I haven't heard much of. So are you, because of the limits have changed over the years, it seems as though what you're saying is there is no real big benefit, unless you've got some major deductions personally. And that used to not be the case. I feel like 20 years ago when I was doing my tax return, like I would donate, clothes and it'd be like, oh, boom, you saved another like $50 or $100.
Absolutely, yes.
That's kind of gone away in general, correct?
Correct. When people bring me their taxes these days, I just say, I don't even bring me those items because you don't have enough. And once again, this is a tax planning strategy. This is a wealth building strategy. Pay off that debt. That mortgage interest is doing you no good. Now, there are taxpayers out there that it helps. I'm not saying it's not, but you have to think about it. That's a large mortgage to be able to take a tax interest deduction for mortgage interest these days. And so you're paying on a high mortgage balance or a high interest rate. But people who have small mortgage balances, I would find a strategy to pay that off and use that money for something else, build some wealth.
Okay, so tax deductions, that's not the way to build wealth.
Nope. And
So
tax. So we'll
so
move on to tax credits.
yeah.
Tax credits are like you buy an electric vehicle, solar panels for your home, energy efficient blinds, those kinds of things. Those are actual what I would call dollar for dollar credits. So if you get a $7,500 credit for buying a new Tesla, that's $7,500 back on your taxes. It's not reducing your taxable income. It's after your taxes are calculated, and you get $7,500 back. That's a straight credit. Those things are
And when you
good.
when someone says, sorry, just real quick, when someone
Yep.
says, I bought this and it's a tax credit, not a tax write-off. Just to clarify, a tax write-off would be more like tax deduction, and a tax credit is what you're saying now, correct? Where it's
Yeah,
every dollar
where
comes off.
where
Yeah.
the government and the IRS is trying to incentivize us to buy electric vehicles or solar or energy efficient things. They're giving us incentives to do that by providing us a rebate or basically a tax credit.
What would you say the top two or three things that we could hear that would be good tax credits that people could take advantage of today, or what you're seeing? What are the top two or three tax credits
The
you see?
top three are solar panels. So people are putting solar on their homes. People are buying electric vehicles or hybrid vehicles that are qualify under the IRS code. And the other one is going back to school, whether they have dependents that are college age. So tuition credits, for example, is a true credit. You get a
So
thousand
like
dollars or 20
University of Phoenix is like $1,000 every course, I think. And so that's a tax credit, 100% tax credit
up to either $1,000 or $2,500. So there are caps.
for the year.
Yes.
Okay, so it's not very much, right?
Yep.
That's like a semester. I mean, a class or two.
And this once again, I talk to my kids about this all the time because they are saying, well, why don't we buy an electric vehicle? And I'm like, why should I pay $80,000 for electric vehicle just to get a $7,500 credit? I'm still out the difference between 80,000 and 7,500. Yes, if I need a vehicle and it's an option I want to choose, take advantage of it. But once again, you're out all that cash just to get a small credit.
Well,
And to
that
build
sounds, but to me, I'm sorry, that sounds like a deductible the way you explain that. I thought a credit is you get 100% of the credit. So if you
up,
spend, oh, but there's a max on
there's a
certain
max.
things.
Yeah. The max
Okay,
credit is
so
$7,500.
is there any particular credit that would be 100%? A plane, that's probably an example, right? If you buy a plane for $1 million, even though you leverage, let's say 80% of it, you'd get a tax credit of a full million. Is that one example or no?
There are limitations though, on all credits are limitations. So they all have some form of a cap.
But planes must be higher because I feel like I hear a lot of people doing that. Not that everyone's going to go out and buy a plane,
Right.
but is that typically the case?
They are higher, yes. Mhm.
Yeah. Okay. Sorry, I keep interrupting you. Is there anything
No,
else
you're
in
doing great. Good
tax
question.
credits
So
that that
credits. And
that
once again,
that
like I say, take advantage of credits. I mean, like I say, if you want solar on your home, my feeling, like this is a good example of solar for me. $40,000 investment. I'm going to save, in Las Vegas, it gets pretty warm and we'll spend $300 to $400 in the summertime on our electricity bills. It could take me 30 years to recoup that $40,000 investment.
yeah.
And you got to take a look at the energy companies are going to raise rates. So that 30-year return, potential time to return my investment, maybe 34 years or 35 because utility rates are going to go up. And is my solar going to last 40 years? I don't know. I hope it does.
Well, most
So
likely you're not going to be there, right? You're not going to be in that
or
house
you're
long
going to
enough.
sell your home. So
Yeah.
I have concerns about spending a lot of money. I mean, once again, I think, and I'm taking the perspective from Horizon Trust Company, and our goal is to help you build wealth. Tax deductions, tax credits don't help you build wealth. They help you take advantage of things you have to buy today and try to take advantage of some tax savings, whether it's a tax credit or a tax deduction. But it's just a small, really, it is a small amount compared to the dollar amount you're investing. Let's just throw an example out. What if you took that $80,000 and put it into an investment for the next 30 years? I mean, what could you get on a return of $80,000? You're probably no better than me. Um, what can be an expected return on $80,000?
I mean, even if it's 10%, right? So if you're getting
Yeah,
$8,000 compounded every year, that's way outperforms getting a tax credit on a $80,000
$7,500
electrical car.
deduction today, right?
Yeah. Yeah.
I think so. And then the third area we want to talk about is tax deferrals. And these are your IRAs, your 401k deductions, your SEP IRAs, depending on if you have a business income. I mean, to me, that seems a better strategy for your money and your cash is to invest in yourself into your retirement. And I know I've got a daughter who's 35 years old, and she goes, I'm not going to even live to be 65 years old. Why should I put money away today? And we've all said that when we were 35. And looking at, the front side of 65, I'm looking, I wish I would have listened to myself back then and invested in myself and either take a tax deferral. And a tax deferral is really, I'm going to take a tax deduction today for my IRA contribution, for example, in a traditional IRA. I'm going to get some tax savings today, but then that is going to grow and accumulate. And when I start taking it out later, I'm going to pay tax on it. So I'm just deferring the tax liability. Um,
I'm gonna let me add to what that example you just gave about your daughter and yourself. That is the I either do a terrible job explaining what I do for a living, um, or it just takes people two, three, four, five times before they start either opening up a retirement account or self-directing. I'd hope it's the latter of the two, but that being the case, I see that all the time, right? I'm at events and out or speaking, and they're like, you know what? I'll start that retirement account in 5 or 6 years, or even when I'm 25 or when I'm 30. And I can tell you, I see people's accounts. I mean, we've got thousands and thousands of accounts, and it is incredible to hear the stories of people who said what I just said. Um, but then bailed on that idea and just started an account with $5,000 and flipped a deal or wholesaled or lent something, and their five turns a 10, and all of a sudden 2 or 3 years into it, their five's 50,000, and they are 50,000 more than almost all of their peers. And so I can't say this enough for those individuals listening as far as tax deferrals go, and what you're talking about here, Little, in the importance of creating a retirement account, that works for you now and doesn't delay. Meaning, most people will say, I'm going to start an account after I pay off my credit card. Now, this might go against Susie Orman or whoever else talks about this, but I can tell you, if you have credit card debt or any debt today, 5 years from now, you're going to have debt still. So start an account, pay yourself first, get this retirement account going, so therefore you can start investing and avoiding taxes and preparing for retirement. So sorry, Little, I wanted to interject that because I see it all the time.
no, I love it. In fact, my youngest daughter had that same conversation and she said, this is the 14th time you've told me this. I think I'm getting it. And once again, we were talking about buying, I think it was buying sweatshirts for a company. And I'm like, how long is that sweatshirt going to last? That this advertising that you're going to do with these sweatshirts, this is going to last 6 months. But I said, if you could take that same $1,000 investment you got in that sweatshirts and put it into an IRA and let it grow for 30 years, how much, we just did the simple math with like you did, how much would she had? And she just was surprised how much she thought she would have. And she goes, well, I should do that. And I said, yes, you should. It's very simple. One other thing I like to talk about on the, taking a traditional approach, whether it be an IRA, and if you have a business, I certainly maximize SEP IRAs or your 401k, solo 401ks, or take advantage of your employer 401ks, whether you do a traditional or a SEP, I mean, a Roth, is that a lot of people say, well, my tax rate's going to be lower in the future. In my history and my preparation, and every taxpayer is different. I'm not trying to say it's a blanket statement, but a lot of people which I do taxes for, they're actually paying a higher effective tax rate today than they did when they 30, 40 years ago. One, because tax laws have gone up, tax rates have gone up, tax laws have changed, things that they can deduct and adjustments. And so generally, I'm seeing that their out of pocket is generally a big chunk goes to paying taxes. And they're like, what can I do? And I'm like, you're 74 years old. There's not a lot you can do at this point. So let's go to the fourth area, which is basically trying to take advantage of tax avoidance. I'm not talking about tax evasion. No one's going to jail. We're not evading paying taxes, but I'm talking about avoidance. And Greg, this is something you're very familiar with. These are your Roths. You know, the more money you can get into a Roth environment, I think for most taxpayers, that is the best route to go. One, because you accumulate tax-free. Yes, you don't get the tax break today. You don't get it, you have to pay a little bit of taxes today, but you're only paying your tax rate. So maybe it's 20%. In some states, maybe it's 30% tax rate, but you're investing 30%. Let's say you take that $1,000 and I'm going to, instead of saving $300 in taxes, it's like I'm paying $300 to invest 1,000, but it's going to accumulate tax-free. And then when I start taking it out, I don't pay any tax on it. And to me, that makes the most sense for any wealth building environment. And so what do you do about people who already have money into a traditional IRA or traditional 401k? Start looking at strategies to convert that to a Roth. It doesn't have to be all in one year. Go to your tax advisor and say, hey, how much can I maximize this year before I go to the next tax bracket? So I stay in the same tax bracket so my regular income doesn't get, a next tax bracket. And just do a little bit each year and convert a little bit each year. And then that money will start accumulating tax-free. I mean, take advantage of the market today, the environment today. There's a lot of money opportunities to be made in the next 10, 15, 20 years.
Yeah, I mean, look, tax avoidance is like the number one thing everyone wants to have. And I think people real quickly, when they hear about Roth, they think, I've heard it, I know it, I got it. But I don't feel like most people totally have it. So let's talk about that a little bit. In particular, I think even there's some questions that we'll go to here with Claudia in a second that are about the Roth and traditional. But if you have a Roth, or if you want to, if you have a traditional account or an old 401k and you transfer it over to Horizon Trust Company, you can convert, like he just said, you can convert a percentage of or all of into a Roth account, and you'll have to pay taxes on that conversion amount. But we've got really good friends that convert a portion of their large accounts every year based upon losses that they're having. So if you know you're going to have some losses, or this year you've got some losses that you can offset the gains from conversion, it is a great time. Most likely, right? Talk to your own
Yep.
CPA and stuff, but see if
Absolutely.
it's a good. But that's typically a great time. I've got a really close friend who's actually an account holder with us, and he has slowly, systematically converted a portion of his traditional account to a Roth self-directed over a 4 or 5 year period, based upon just wanting to, just enough so he's not having to, pay taxes on those conversion dollar amounts.
It's very disciplined. I mean, people have to be very disciplined, once of all, to put money away for retirement, whether it's traditional or Roth. I mean, you have to be very disciplined to be able to do that and to put it into your budget. I think likewise, those people who are disciplined can do the same thing, like you mentioned with the Roth conversion. It's just like, let's be disciplined and do as much as we can this year, next year, maybe not the next year, because we got a lot of income coming in. But 3 years from now, we're going to be in a down year. Let's do some planning. We've got several people that have taken, traditional IRA today and knowing in 3 or 4 years they're going to plan on converting it because maybe they do have a real estate investment that's going to pay off in the next 1 or 2 years, and then they're going to have a slack couple 2 years until that their reinvestment comes and their accumulation of value comes. They're going to have a slack 2 or 3 years where they can do the conversion. So there are opportunities. And we know that there are limitations on Roth and getting money into Roth accounts. And so you might have to do what's called the backdoor Roth, do a traditional IRA and then convert it to a Roth later. But our counsel, my advice would be do it as fast and as soon as you can. And the sooner you can, that's just going to accumulate. One thing that does for those that are of RMD age or soon to be RMD age, there are no RMDs for Roths. So that solves that whole problem there. So there are ways in which you can utilize this to be able to build wealth. We're all going to live longer. We're going to live many more years, and we want to be comfortable through those wealth years.
I mean that is the big thing, right? I mean, right in the last decade, I feel like it's all about health, what we're eating, seeing your doctors, and people are living longer. Life expectancies are getting longer. And so therefore your money has to last longer. So these little tricks of converting things to Roth, so therefore you're not paying taxes later, could be a difference of you having an additional 2, 3, 4, 5 or longer years of money in your accounts. And so it's critical. So look, let's take a little bit of a break and go to some questions because I saw a lot come in. And two things where I'm gonna move to Claudia here, and in doing so, a couple things. I also failed to say at the beginning of this, we're gonna have a gift here at the end, and 20 minutes or so that we're going to give out like we've been doing recently. So for those of you stick around, we're going to do a gift and for one lucky person that we're going to give away. And then number two, Claudia, I want to introduce. Claudia is on our team and oversees all our new business and new accounts. There she is, sitting there with Mr. Little. Hello, Claudia. How you doing?
Good. How are you?
Good, good. All right. So Claudia helps oversee and brings in, helps oversee all new business at our company. And so, that being said, you put a face to the name. And that being said, Claudia, you want to give us some questions that we can kind of tackle? Let's take a little break here, but and then we can go back to some of these other items I think Steve might be prepared with.
Yeah, absolutely. So somebody asked here, David, would you advise on a conversion and how would it work? I think we went over it a little bit more, but they want to know, like, what about converting a 401k to Roth at age 65?
I would just make sure I would make sure you get with your tax advisor and make sure you look at the tax brackets and play the game of the tax bracket. Keep it into the same tax bracket you're in. So the money you're converting is at the same tax rate. You don't want everything jumping up into a higher tax bracket just because you converted a large sum.
So
It's
what give us like, sorry Steve, I interrupted you.
Yeah.
What's a number where it jumps back up to a certain, like, what at 125 it goes to another, what's the number, give me one example.
It's going to be different if you're married or single, but a good example would be about $149,000 is probably an area where it's going to jump up in a bracket. 210,000 is another
So
bracket. So you got
let's
about
just
a
take that
70.
example, 149. I want to take that example.
Yep.
And if you've made $130,000, um so if you got that, made $130,000 and you converted 50 or $60,000 of a traditional, that would essentially jump you to the next tax bracket, and you'd pay taxes on a higher number for all of that money, correct? And
Not
so
all
that's
of
what
it. Not all
for
of it.
just the percentage above the 149.
Correct.
Yes.
Yes.
Perfect. So that's what I think. I just wanted to clarify because even myself, obviously, I want the listeners to understand is, and when he says jump up to a higher tax bracket, that's how that would work.
Yeah, you get advantage of all the lower brackets as you go up in income, and then the money that's over that next bracket, you pay at a higher rate. And so just a little bit of planning on conversion would just say, hey, I'll take this much this year and this much next year. And in the next 5 years, and by the time I'm 70, I've got this all converted to a Roth, and I've got another 20-year lifespan here easily. So
Yeah.
How soon into the year do you think that somebody should be talking to their CPA and kind of strategizing how much they are going to convert and what their tax liability is going to
I
be
would
for
say
the year?
before the year even starts, they
Right?
should have done it last year. Going into this
Yeah.
year, they should have already had a plan, but the sooner the better.
Yeah.
And that way, if you see something coming up where you may have a stock sale, you may want to sell a property, or you may have something else that's going to create income, that can make your decision whether you wait until January 1st of next year, maybe
Mhm.
to put it off.
And somebody's asking, I do know the answer to this, but maybe you can expand on it, is if I were to convert today, that would be for 2024. Why couldn't they do for 2023 if they haven't done their taxes yet?
Yep. December 31st
Yeah.
is that key on that date. So
Yeah. Yeah, we have a lot of clients that actually ask this because they haven't done their taxes and they know that contributions can be different. It's different for conversions. Conversions have to be at the end of the calendar year. It's an IRS rule, and if you talk to your CPA, they will validate our response. It's not something that we put in place. So talk to your CPA and make sure that you're having those conversations throughout the year. They don't have to be long. I can be, 5, 10 minutes. Walk into your CPA's office and just tell them, hey, what are you thinking? And go from there. So easy conversations that you should be having throughout the year with your CPA. Nancy, it wants to know what is the max amount you can contribute to a Roth IRA and a solo K this year?
so on the Roth, it's $7,000 unless
It
you
went up to 75?
75
Yep.
plus the catch up
Yes. Well, with the catch up.
with the catch up
Yeah.
if you're over 50.
If you're over
Yep.
50.
But there are income levels.
Yes.
I don't have those memorized,
I
but
can look them up. I think they went up as well.
yeah,
One of the things is that every year the IRS does
adjustments to those
make
tables.
adjustments. So we can definitely go over that with you as well. And for the solo K contribution limits, it is 69,000 this year. So it went up significantly from last year, and $7,500 for catch-up contributions.
And that's assuming you have what I would call the self-employment income to be able to do that, whether it's a W-2 or Schedule C income. You have to be somewhere in the mid 300,000s of taxable income
Yeah.
to be able to maximize at 69.
Yes.
We
Plus,
have a
How?
lot of clients that do this, by the way. A lot of our clients who are business owners who are trying to catch up and don't have a retirement plan or very small retirement plan, setting up a solo K, a 401k, and doing these big contributions are game changers, right? Rather than starting with $7,000, you essentially, again, depending upon how much income, taxable income you've had, you can contribute to $69,000. Most people don't know they can actually do that. It's a big deal. It's a big deal.
yep, and it's great because you get that money into investments. And I know a lot of people and a lot of CPAs and tax accountants don't like self-directed alternative assets and things like that. But at Horizon, it gives an opportunity to diversify. I mean, we have with Axos Clearing an opportunity if you want to be in the stock market and you want to be in that traditional asset purchases, we have a provision. I mean, you can sign up and you can invest and buy stocks. If you need an advisor, they have an advisor available within Axos Clearing. We're not advisors, or you can do direct on your own. But then also it gives some flexibility if you wanted to buy an alternative asset, let's say a rental property. That's the best way to go.
Okay, so we have some questions on YouTube that I was just told. Does the self-directed IRA work the same way where I contribute $500 a month? So I guess they're asking, can they do a recurring $500 monthly?
Absolutely,
Yeah,
yes.
same thing. Yeah, you can definitely set that up. Our team is very knowledgeable in that aspect, so you can definitely call us and we'll be able to set up that kind of IRA for you. Would you recommend to have a Roth IRA account and a self-directed IRA? So that's a good question.
Yeah.
You can have it's the same thing.
The
So
self-directing is who the custodian is, and in the self-directed environment, you self-direct. You are your decision maker. You don't necessarily have an advisor. Let's go back to what I would call traditional assets, which are your stocks and your bonds. You would have an advisor at Merrill Lynch or TD Ameritrade, and they would be your custodian. And a self-directed, you would have to have a custodian like Horizon Trust that holds your assets, but you actually direct your investments.
How does it work when somebody wants to do a conversion? They don't want to liquidate and they want to do a conversion of just a part of the property or a part of the investment.
If it's a
If it's a self-directed,
right.
yeah.
The market value, they would take the market value and how much of that market value they'd want to convert every year.
They would work with their CPA on that?
Yes.
Okay.
They would give us some valuations. They're still going to have to come up with the tax part of it. It's not going to be someplace that we can do the withholding, but because there's not cash available.
Sorry, I want to just, for new people on this subject, I want to just clarify what you just said. Uh, if you have no liquidity in your IRA account, and your IRA, self-directed IRA account, is holding an asset, a piece of real estate, let's say, a note, but you want to convert it to a Roth, you can do that. There is a way of doing that. And that's what they're talking about. So I just wanted to slow it down for those that might be new to that. You just, since you don't have the liquidity, you're going to have to most likely, right, pay it out of your pocket.
Out of your pocket.
And that's how you convert it. If your liquidity is, well, there is none and your money's in an asset. So that's.
And I know I've seen one, many people have asked me, well, what if my fair market value is zero? Let's be careful here. We're not trying to be tax evaders here. We want to be
That's
upfront
the
with the
fifth
IRS.
step, tax evader.
Tax evaders, which a lot of our competitors will. No, I'm just kidding. But that's it's something you just got to be realistic and like I say, that's our responsibility to make sure of that we are trying to help you stay in compliance.
Yes. Yes. This one is a good CPA question. With the solo K, can you have W-2 income and business income, and how does it work?
It does. So in essence, the solo income treats if you didn't have an actual W-2, it treats it as if you had a W-2. The fact that you have a W-2 is really a good thing, because the amount that goes in is an employee portion up to its limitation. That's 23,400, somewhere in that range.
Yes.
Now, so that's the employee contribution. And then the employer makes a contribution on top of that to get to the max, if you max out to the 69 or 60. Yeah.
Perfect. Somebody's asking, are you tax advisors or financial advisors?
Neither.
Yeah, neither.
Strictly custodians. And so the role we play as a custodian is making sure that it's really about compliance. We make sure that you comply with all the rules that are out there. When we do get into disagreements with clients about compliance, and we'll have to get their CPA or their tax attorneys involved, and they give our opinions, and we take the same aside with our legal advisors, and we take our position, and we try to come to some resolution. And we are here to make sure that you're in compliance with the IRS. We don't want any problems, any avoidance, but we do not advise at all.
Mm-hmm. And one thing that we do let everybody know, Steve is a CPA, but he's not your CPA. So we need your CPA to give you your advice and make sure that they know they're the only ones that know what your financial situation is. So it's important. We can't give you that kind of feedback. We can guide you and keep you compliant, but when it comes to actual contributions and seeing what your financial situation is, it's only your CPA. He's my CPA because I'm very lucky, but not yours.
That's great. And like I say, and every situation is different, and we throw out just generalities of advice. One thing that comes up a lot, Greg, and Claudia, is about real estate. A lot of people say, well, I don't want to hold a real estate in my IRA or my Roth or my SEP or anything, because I want the tax advantage. I want the tax write-offs today. I want to be able to work on the property, all these different things. And so, in thinking about that, I agree. Some people would like to work on their properties, and putting their real estate in a retirement account is not going to work for them. But once again, the tax savings, you go back to number one on our list today, it's just a tax deduction. And then once again, if you're losing money on a real estate investment, then we probably need to get an advisor involved to talk about, you have an investment that you're actually losing money every year. Granted, some of this is non-cash, meaning depreciation, but that's just a timing. You're going to have to what's called recapture that depreciation, pay at a higher tax rate, then pay the capital gains. You're going to have less cash available for your next investment because you pay taxes. Sometimes the better wealth building is to let that money accumulate, and now I have 10 or 20,000 more dollars to invest in the next real estate project and the next one and the next one. and you keep flipping those 10,000, 15,000 extra dollars every year that you didn't pay to taxes, you can build wealth in a hurry.
Mhm. Yeah, I
Let
agree.
me, before we've got lots more questions. Don't worry, we're not done. We're going to answer probably all of them. But I do want to mention, and Alex, maybe pop it up here, a link for those of you that have an IRA or an old 401k. And again, half of you are new listening to this. If you want to learn about how to, do some potentially tax avoidance and or deferral using your retirement account and investing in alternative assets, click on the link. It's going to be in the chat. There it is. Thank you, Alex. If you click on the link, set an appointment with our team. It's not a hard sales pitch at all. This is for us to help answer questions to see if we can answer any questions of what kind of account's right for you, and if you want to self-direct. We're going to go back to the questions here, but I wanted to just reiterate for those of you, the links here in the chat. Schedule an appointment with us. Love to help you. Or contact us and we'll answer questions about your account to see if it works for self-directing with us at Horizon Trust. So that's my commercial. Go back, Claudia. Go back to some of these questions. I see a lot of good ones coming in.
Yes, I have a lot of people asking, do we have a CPA referral? I get that asked a lot. I don't have any. You have any?
We really don't. Once
Yeah.
again, I could give you a list of 10 or 20 people, but then again, it's really, because it's really finding somebody that where you're at in the phase of your life and finding that advisor. And yes, it does take time to go through, but we don't, once again, give out legal advice or CPA advice. And it's very difficult for us to say, hey, this is our specific CPA for anything.
I agree. We try to stay in the middle. I have Jeffrey that
Look, I will on answer too. I've had to go through this process, finding a new CPA, and the best place to start, in my opinion, is with successful people that you know, like, and trust. Who are they working with? Do they like them? Are the fees right? I'd then interview two or three of them. And after you interview two or three, you're gonna have a really good idea. And if you don't feel good about one of them, just keep interviewing them. But I think it's not as hard as you might think it is. I would ask your own community, people that you know, like, and trust. So go
And
ahead,
I
Claudia.
would throw out there that not all CPA and tax preparers understand self-directed investments and understand retirement. They don't. That's just, it's not the niche that they do. And that's just the way it is. A lot of tax preparers are in a niche. There are some very good ones out that know a lot of things and know a lot of breadth, and have big firms, but a lot of tax preparers are small firms.
Mhm.
Yeah.
So to add to that question, is there something that they should be asking before they hire a CPA? Is there like a keyword or something that, because they have this type of retirement account, is there something that they should be requesting?
I think I go back to the one question when you ask people about their investment tolerance.
Mm.
Are you
A good
aggressive?
one. Yeah.
Are you conservative? Are you in the middle? Where are you? And I think you have to ask and be comfortable with your tax. And some tax preparers, very conservative, very narrow, very not outside the box thinking. And I'm not trying to pick on anyone. They're staying in the very hard line of compliance. And you've got the very aggressive and over the top ones, and you want to stay away from them, obviously. But you got people that have to understand that the tax laws are there to be taken advantage of. That's why they're there. They're there to protect us, yes, and they're to protect the taxpayer, but they're also there to find the loopholes and find ways to save taxes. And it's not a tax evasion, it's not illegal. It's just using the tax law to your advantage.
Very good. I have somebody that says, if I am a year away from retirement, should I wait until my income drops to zero to transfer my traditional IRA to a Roth IRA?
I would think that would be pretty decent advice. When are they going? Question would be, when are you going to start withdrawing your retirement?
Yeah.
Um, and then, like I say, I would come up with a tax strategy over a number of years. In this case, depending on how large their retirement is. And it may, once again, pay attention to the tax brackets and maybe just do a phased approach over 2, 3, 5 years. It's okay.
Mm-hmm. Very good. I have Jeffrey that says if I don't have hers and heirs and in a low
Yes.
tax bracket, is it still practical to convert my traditional IRA to Roth? Or maybe just a portion of my traditional IRAs?
I believe so. Once again, you're going to be faced with an RMD calculation at some phase in your life, even though you don't have heirs. Um, so once again, why not try to avoid having to be forced to take out taxable income when you can basically decide when you want to do it by doing a conversion. And it doesn't have to all be at once,
Mm-hmm.
and it can be planned.
Okay, perfect.
And there are tax planning out there for charitable contributions from your retirement plans. Like say, if you don't necessarily have someplace specifically and you want to donate it to certain trusts or certain charitable organizations, there are a way to convert up to $100,000 of your IRAs back into charitable contributions. So that could be part of the planning, and that is tax free. And so, way to get rid of some of that wealth is to donate it to charities
Mm,
through your IRA, and then not have to pay tax on that money that's distributed to a charity.
okay.
And then you can convert some to a Roth. You can do a lot of planning that way.
Oh, there you go. Okay. Nancy's asking, can I own more than one Roth IRA?
I would say yes, guys. What do
Yes.
you think?
Yes, you can. Your contribution limits are going to be the same whether you have one Roth IRA or 10 Roth IRAs. So you just have to make sure that you don't over contribute because then the IRS does not like
Mhm.
And like some people have inherited accounts as
that.
well as, yeah.
Yeah. Um, okay, another question. Do we need to include our self-directed IRA even if we have not made any movements with it? I'm not sure I understand that question, Alma. This is from Alma. So if you want to put something else in the chat to
I
get some
wonder if that's
clarification.
reporting for fair market value. And
Oh, maybe, yeah, like reporting for
you
how
always
it's
have to
doing.
report fair market values, even though technically there's been no activity. We do need to have that. That does affect the RMD calculations. That is reportable to the IRS. That's something as a custodian we have to provide to the IRS, and therefore we have to obtain you. So I'm assuming that's what it's about, reporting.
Reporting.
Um, and maybe it might just be, is she going to get a 1099-R, meaning, and if there has been no contributions, no distributions, probably not, but then we will probably have to report the fair market value.
Perfect. There you go. Olivia is asking, what is the best self-directed account for private lending? So any self-directed account can do private lending. So if you have a 401k, you have a Roth IRA, any self-directing means that you have the ability to do that as part of your portfolio. So any self-directed account with us, you can go ahead and do private money lending.
Yeah, and a large percentage of our clients do that.
Yes,
Private lending.
it's a big investment that we do. We have Jordy that is asking, is there any non-recourse lenders that will refinance a free and clear property owned by a self-directed retirement account? I've never had that question, so.
I know the answer to that. The
Okay,
answer is
go.
yes.
Okay,
We have non-recourse lenders, and so if you message us, make sure we have your email. We can refer you. There's non-recourse lenders that will lend up to 50%. So if it's paid for free and clear with your IRA can then borrow typically up to 50%. So we can introduce you to them, and you can kind of go through that process.
And
yes.
talk about borrowing real quick. When Axos Bank was here just a few weeks ago, they've got a program out where essentially you can take your portfolio and pledge it as a down payment on a piece of property. So normally, when you go to borrow money, you have to come up with cash for down payments or for your equity portion of it, which means sometimes you have to liquidate your stock portfolios or liquidate any other types of assets to create cash. That could create a taxable event. What Axos is plan and has been doing is saying we can utilize your stock portfolio or your self-directed portfolio as basically your asset to your down payment. We will give you the loan with that. And then you can take advantage of the appreciation values of your portfolios as well, and then be able to invest in real estate without actually having to come up with cash. I think to me, it's a very straightforward and forward-thinking program by Axos. I'm really excited about it. I think it's a great opportunity. And those that are out there that want to buy more properties, but maybe be a little cash poor at the moment, I think it's something to look at.
Very cool. Okay. Well, Greg, if you want to go ahead and close us out, I know that we have a gift. Do you want to say what the gift is? Do you know what the gift is?
I don't
I
know
don't
what the
think
gift
Dave
is.
knows.
I know what the gift is. Yes, I do. So, and there's also a couple questions left on here that we'll try to do one or two after this gift. So, but before we do that, let's do the gift. I like it. So, let's pick a number between 1 and 240. 'Cause I think that would
Steve, you
cover.
pick.
Little
You pick the number,
you
and I'll
pick the
say the
number, and
name.
then and she will say the name, and they're going to get a free LLC, from
Nice.
us.
The number that came to my mind, and I even hate to say this number, but it's 99. Aaron Judge from the Yankees. I'm not a Yankee fan. We talked about baseball earlier, but somehow he came into my mind. So 99 is the number.
Back to sports.
I know.
Can't get rid of them.
All right, well, good. Well,
All
Claudia,
right, so 99.
who
Let me
is
go
that?
ahead and
That's between here and YouTube.
perfect. So our winner is Jeffrey Von Clock.
Awesome.
Jeffrey.
Congratulations.
Yeah, congratulations. Are you still on? You are.
Gotta be on, or else you don't get it.
And I'm glad you're giving out an LLC because I think it's
Yes, there he is.
it's a useful tool. It is a very effective tool, and it should be something that you should put into your self-directed plan. Because I think it gives you freedom, it gives you accessibility, not that you're going to use the money personally, because you're never going to do that, but it helps you to speed up some of the investment processes. If you wanted to buy a simple CD, you just take your money from your checkbook LLC and put it in with a CD for a few months. I mean, take advantage of the higher interest rates in the CD market right now until you find a better investment.
Well,
Jeffrey's asking, what do I do with it?
Call that number on the phone and
we'll do a call with you. So Jeffrey,
Yes.
just make sure we got your email. Look, Claudia, is there one more question I thought I saw that came in that we want to quickly answer, or did we already answer it?
So I have somebody that said, can we convert a TRS into Roth IRA? So TRS must be a type of account.
Like a specific retirement account. And yes.
Yeah, so
it depends. I mean, obviously, if you're under 59 and a half and you're still working, you can't convert unless the plan allows for you to convert. But those are out there that have 401ks or teachers unions, anything like that, that's specific pension plans. Check into your plans. If you're 59 and a half, you can take out your retirement and put it into a self-directed and diversify and get it into something different. You don't have to wait till you turn 65. That's one of the great things. And not all plans allow for it, but majority of the plans do. And obviously it's just a custodian to custodian transfer, no tax effect, and then you're off and running. So I think that's another tax planning strategy people need to look at and say, I'm in a 401k that's in the stock market that's tied to my employer, but I'm still working. What do I do? Say, if you're over that age, talk to your pension plan administrators and say, I want to do basically a withdrawal.
And what a lot of people
go ahead. Quickly.
What a lot of people don't realize is that they don't have to do a complete rollover. They can transfer, a couple $100,000. I mean, a small amount. It doesn't have to be the whole account. We can help you kind of strategize and see what your end plan is. And we can just do a portion of what you have available in another custodian and then self-direct that part on this side. So that's something that you could go over with an IRA specialist here at Horizon.
And like we talked about promissory note lending, and most people are getting 10, 12% return, and it's just a fixed monthly amount that goes back into their retirement. I think it's an option for a lot of people.
Absolutely.
Okay, I got one last question here. Steve, is there a best corporate vehicle to put your traditional self-directed IRA into for making passive real estate investments? C Corp, S Corp, LLC, in order to get taxed at corporate tax rates instead of ordinary income rates?
well, once again, it's self-directed means you're not going to get taxed at all. So the entity structure really is more about asset protection. And to me, an LLC seems to be the cheapest and easier way to do that. Now, if you're talking about retirement funds, is that what they were asking, or were they talking about self-directed?
Says
Saying to get
best
closer
vehicle
to
to
the
put
mic.
your traditional self-directed IRA into for making passive. I would say they're talking about an IRA. So I
IRA,
would
yeah.
say
So
LLC is typically the best in
yep,
that scenario.
LLC is typically the best, and you're really just looking for protection of your asset. It's not there for your tax payments every year, obviously.
Well, great. Look, we'll wrap up here. And again, the link's in our chat. Please schedule an appointment if you've got an IRA or an old 401k and you wanted to figure out how to use it in alternative assets. We're here, we're around. Hopefully this was information, educational. As we wrap up, what's one thing you're looking forward to in the year 2024?
24. I hate it's going to bother Claudia, but I'm looking for baseball season to start. I'm not a big NBA fan, and obviously football's over. We'll get some March Madness, but I'm looking for baseball season. I'm up for opening day.
There you go.
In fact, you and I were at an event, and I got some Arizona Diamondback tickets at that event. We were at that charity event, and so I'm looking forward to using those. So.
Oh, that's
Well,
awesome.
good. Well, good. Well, look, thanks, Steve Little, for sharing with us, and Claudia as well for being with us today. And hopefully, this is helpful and informative for those on here and listening. So, if we missed a question, apologize. You can always email us. We'll do a quick call with you.
You can always
and
call
get
us
back
and
to you.
ask for me if you want. Talk to me specifically.
Yep. All right, guys. Have a great evening. Thanks for being with us.
Hey, thank you, everyone.
Bye.
Hey, thanks for watching this video. Hopefully you enjoyed it. There's lots more great content for you to learn and enjoy and apply to. And so anyways, click on the link below and listen to more videos or set an appointment with us. We look forward to hearing from you and also helping you.